Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, February 18th, and today's theme is calmer inflation, jumpier everything else.
Prices are maybe behaving, but markets are still acting like they drank 3 espressos and read one scary AI thread.
We'll cover 5 things: UK inflation cooling, a markets wrap where stocks bounce as AI jitters ease, gold rebounding above $4,900 an ounce, oil jumping on Iran headlines, and Bitcoin sliding with risk-off mood.
And we'll keep it practical. What this means for your mortgage, your grocery bill, and your portfolio, aka your 3 most emotionally fragile relationships.
Story 1. UK headline CPI cooled to 3.0% in January 2026, a 10-month low, with core down to 3.1%. The coverage flagged easing food and transport costs, while services inflation stayed sticky, so the last mile is still a grind.
So, headline inflation is calming down, but services are like, I heard you wanted a discount. Best I can do is a wink.
Simple version: goods inflation is often about supply chains and commodity inputs. Those can fall fast. Services inflation is mostly wages and rents. Those fall slowly. That's why central banks watch services like a hawk.
Basically, groceries can go on sale. Your haircut does not go on sale, unless you cut it yourself, and then the cost is emotional.
Why it matters. The report suggested pressure is mounting on the Bank of England to pivot, with talk of a potential cut to 3.5% at the March meeting. If markets buy that, UK mortgage pricing and consumer credit can loosen at the margin.
Action item for normal humans. If you're on a variable rate, pay attention to March. If you're fixed, don't panic, refresh your banking app. Refresh your emergency fund instead.
Markets wrap. U.S. stock futures rose as dip buyers stepped in after sharp swings tied to concerns over artificial intelligence. The key point: volatility wasn't just earnings, it was narrative risk, people repricing the future.
Narrative risk is when your portfolio is fine, but your group chat is on fire. One minute it's AI changes everything. Next minute it's AI eats software profits.
Simple version: when investors think growth is durable, they pay up for future earnings. When they worry the story breaks, competition, regulation, margins, they demand a bigger discount, and prices swing fast.
So dip buyers are basically saying, I still believe in the long-term story, and I love a sale, which is adorable until it's not a sale and it's just the new price.
Story 3. Gold climbed back above $4,900 an ounce. Gold often reacts to real yields, dollar moves, and risk appetite, plus positioning. When people crowd into the same trade, small shifts in expectations can cause big moves.
Gold is the friend who shows up when everyone's stressed and says, I brought stability, then immediately changes price by a lot for stability reasons.
Practical take: if you use gold as insurance, size it like insurance, so you can hold it through noise. If you trade it, respect liquidity pockets and headline risk, because metals can gap when macro stories flip.
Also, please don't treat a gold chart like it's a personality test. It's up today, so I'm a genius. No, it's up today, so the world is weird today.
Story 4. Oil jumped more than 2% after comments that Iran ignored a key U.S. demand, with military strikes on the table. The market worry is supply disruption risk in the Middle East. Oil prices are basically a geopolitical stress meter.
Oil is the one commodity that can reach into your life like, nice budget you have there. Would be a shame if something happened to your commute.
Why it matters. Energy feeds into inflation expectations and transportation costs, and it can complicate central bank plans. Even if CPI is cooling, an oil spike can reheat the conversation fast.
So we're cheering for lower inflation, and oil is in the corner like, not so fast. It's the plot twist nobody asked for, but everyone pays for.
Story 5. Bitcoin declined again amid geopolitical tensions and a broader risk-off mood, with reporting noting sentiment as bleak. Another technical lens out there frames it as a battle with the $70,000 level. Psychology matters in markets, even for math money.
Math money still has feelings, apparently. $70K is like the velvet rope outside the club. Bitcoin keeps trying to get in, and the bouncer keeps saying, not tonight.
Simple version: in risk-off, Investors prefer cash-like safety and predictable earnings. Assets seen as high volatility, like crypto, often get sold first. That doesn't prove a long-term thesis wrong. It just describes the current regime.
Action item. If you're a long-term holder, stop letting every red candle rewrite your identity. If you're trading, decide your risk before you click, because the market will decide it for you otherwise.
Quick recap. UK inflation cooled, raising the odds of a BOE pivot. Stocks steadied as AI jitters eased. Gold popped back above $4,900. Oil jumped on Iran risk, and Bitcoin stayed under pressure in a risk-off tape.
And the vibe is, we might get rate cuts. Unless geopolitics and energy prices decide to start a group project with volatility.
If you found this useful, subscribe and come back tomorrow for the next briefing. And comment with one word, cuts, if you think rates head lower soon, or sticky if you think inflation fights back.
Also, send this to a friend who says they're diversified because they own stocks, crypto, and anxiety. See you next episode.